What is a non-controlling interest? How does a non-controlling interest get created? What are the journal entries to record a non-controlling interest? And where does a non-controlling interest show up in the financial statements? Which of the financial statements mentions a non-controlling interest? Is it the balance sheet, the overview of what a company owns and what a company owes at the point in time? Or the income statement, the overview of the profit or income that the company generates during a period? Or the cash flow statement, the overview of how much cash the company generates and where it spends that cash during a period? The answer is all of the above. Let's illustrate how a non-controlling interest works from a case study of Walmart, one of the largest retail companies in the world. In equity on the balance sheet, they have a non-controlling interest balance at the end of the year of $6.9 billion. In the income statement, $320 million of net income for the year is attributable to non-controlling interest. This amount is deducted from the consolidated net income in order to report what is the consolidated net income attributable to Walmart. And in the cash flow statement section, cash flows from financing activities, $555 million of dividends were paid during the year to non-controlling interests. This is a cash outflow. Let's start off with investigating how non-controlling interest gets onto the balance sheet, and then examine the relationship with the income statement and the cash flow statement. Most of the non-controlling interest balance in equity on the balance sheet is related to Walmart's acquisition in August 2018 of a majority stake in Flipkart, an Indian-based e-commerce marketplace. The non-controlling interest is the share of ownership in the subsidiary entity Flipkart that Walmart didn't buy, but somehow has to account for. Walmart bought 81% of the outstanding shares, or 77% of the diluted shares. According to ASC 805, for a business combination to occur, an acquirer must obtain control over a business. This condition of obtaining control is satisfied, therefore Walmart began consolidating the financial statements of Flipkart in the third quarter of fiscal 2019. Through the line non-controlling interest, Walmart represents that it doesn't own the remaining approximately 20% of the equity in the subsidiary. Let's reconstruct on a very high level what Walmart's journal entry is for the acquisition of Flipkart. Walmart assumes assets valued at $24.1 billion, including goodwill and intangible assets. Walmart assumes liabilities valued at $3.7 billion. The non-controlling interest of around 20% of the shareholder capital in Flipkart is valued at $4.3 billion. In return for 81% of the outstanding shares, or 77% of the diluted shares, Walmart pays approximately $16 billion in cash. So the high-level journal entry is debit assets, $24.1 billion, credit liabilities, $3.7 billion, credit non-controlling interest, $4.3 billion, credit cash, $16.1 billion. That's how a non-controlling interest gets created on the consolidated balance sheet. To understand how the ending balance of $6.9 billion on the balance sheet on January 31st, 2020 has developed over the years, we turn to an often overlooked, but in this case very useful schedule called the Consolidated Statements of Shareholders' Equity. This has a column for non-controlling interest with a walk between the balances. The ending balance of the Consolidated Statements of Shareholders' Equity ties to the ending balance on the balance sheet. 2 years prior, the balance was $3 billion. Last year, the balance was $7.1 billion. Currently, the balance is $6.9 billion. The biggest addition to the balance of non-controlling interest in recent years was the $4.3 billion related to Flipkart that we have just discussed. What are the other major movements in the non-controlling interest balance? First of all, the non-controlling interest balance goes up when the part of the consolidated net income that is attributable to the non-controlling interest gets recorded. This is the link between the income statement and non-controlling interest in equity on the balance sheet. Second, the non-controlling interest balance goes down when dividends are declared to the non-controlling interest. This is the link between the cash flow statement and non-controlling interest in equity on the balance sheet. Non-controlling interest, the share of ownership in a subsidiary's entity that the parent company does not own. It is reflected on the balance sheet in equity, in the income statement, a share of the net income, and in the cash flow statement, cash outflow in financing activities when a dividend to the non-controlling interest is paid. Want to learn more about business, finance, accounting and investing? Then subscribe to the Finance Storyteller YouTube channel and start watching the next video in the recommendations on the screen. Thank you.